Well, hello everyone, and welcome to the latest installment of our virtual investor events at NZX. My name is Doug Graham, and I'm with the Capital Markets Origination Team here at the Exchange. Thanks for joining us, and for those who aren't familiar with these webinars, the goal is really to present some of New Zealand's top listed companies, along with some of the top thinkers in the financial market industry. And along those lines, today we have three presenters, and we'll get into the details of that in a minute. But just a quick rundown of the format. Each presenter will go for, maybe 10 minutes or so. It sounds like today it will be really more about the Q&A section of our presentations as well. So after the presentations are done, the Q&A session will be live, and you can ask questions in the chat panel of your webinar screen, and just ask those in, and we'll get them filtered and onto the presenter. If we don't, we really encourage you to ask as many questions as you have. If we don't get to all of them, we will have your name and email and can forward you the answers after the event. So today we have a great lineup. We've got Mark Lister from Craig's Investment Partners, Sophie Maloney from Sky Network Television, and David Mair from Skellerup. And we'll start it off here with Mark Lister. And Mark works at Craig's Investment Partners, is the head of private wealth research. He joined Craig's in 2004, has a regular presence in the business media. His team at Craig's provides research to help clients make more informed investment decisions. And with that, I will turn over to Mark, and I'll jump out of here. And Mark, you can take it from here.
Thanks, Doug, and afternoon, everybody. Look, I'll do my best to whiz through a pretty busy year and a pretty eventful time for financial markets, and we'll try and leave some time for Q&A because I know there's an awful lot to talk about. Look, in a nutshell, at the beginning of this year, we always expected it to be a much more challenging year. Last year was sort of the year of recovery. Earnings growth at the corporate global level rebounded some 50%. The world was reopening. You still had very easy monetary policy, and it was a pretty good year for investments. This year was always going to be different because some of those tailwinds were always going to turn into headwinds. And so we did expect to be much more modest year, and we expected returns to be something that looks a lot closer to what we'd sort of call normal. The last 3 years have been very strong. Returns from global shares have been anywhere between 15 and 25%, and the long-term average is closer to 7 or 8. I guess what's made this year even more volatile is that most investors across the world have underappreciated just how strong the inflation pressures would be. So inflation was showing lots of signs of increasing last year, but it's really just carried on, and it has proved to be much more persistent and much more broad-based. So you've got New Zealand inflation at 5.9%. It'll go higher. It'll probably start with a 7, I would think, over the next couple of quarters. In the US, their inflation rate, we get the latest figures on Thursday night. So you'll wake up on Friday morning, the US inflation rate will be 7.8%. That's the highest since 1982, since Ronald Reagan was president. And it's the same story elsewhere as well. So very persistent inflation. And this is before you sort of think about the oil prices and the commodity prices that are happening as a result of the Russian invasion of Ukraine. It's wage pressures, it's staff shortages, it's commodity costs, it's supply chain issues. All of that is feeding into higher inflation, and it's looking quite broad-based. And the reason that's so important for investors is inflation is the key driver of interest rates. So if you're a central bank with a reserve bank here, the Federal Reserve in the US, your main job historically is to keep prices stable, to keep inflation in that sweet spot of 2 or 3%. So when it's not high enough because you're in recession or you've got a weak economy, they lower interest rates to sort of encourage us all to spend and borrow and so forth. And when it's too high, like it is at the moment, well above that sort of 2 or 3% sweet spot, their key tool to get it lower is to raise interest rates. And that's really important for investors because interest rates are a big driver of asset prices. So whether you're talking about houses, shares, antiques, classic cars, bonds, whatever, artwork, you name it, interest rates are a big driver of asset prices, and the low interest rates that we've seen in recent years, recent decades almost, that has been why asset prices have risen as much as they have. So people are focused so much on inflation because they know that inflation will drive interest rates, and interest rates will drive asset prices and ultimately returns. So that sort of has dominated the thinking over the first maybe 6 weeks of this year through January and through February. Everyone came to the realization that, look, the Reserve Bank in New Zealand is going to crank up the OCR much more quickly than people thought before. It's at 1% now. It'll end this year at 2.5%, and then they're trying to push it higher. The Federal Reserve in the US is expected to increase their OCR 5 times this year. The QE program goes into reverse. So all of these things, they don't necessarily spell doom for financial markets, but they're just, a headwind. They just make things more difficult. They tighten monetary policy, they take money out of people's pockets, and they impact the value that investors are willing to put on assets. So that's sort of what we were grappling with over the first 6 weeks of the year. And over the last 2 or 3, it's obviously been the Russian invasion of Ukraine, which no one can predict how it will play out. Geopolitical events, really impossible to predict how they develop. Generally, they don't tend to be long lasting. They do tend to blow over, but you never know. You don't know sort of how far it escalates and sort of where Putin sees the opportunity to sort of, retrench or back off or go home without having lost face. So it's difficult to see the end game there. But as far, it's obviously creating a lot more uncertainty, and it's also adding to those additional pressures. So we're already worrying about that inflation backdrop. And now you've got oil prices and grain prices really high, and that is also feeding into that inflation thematic. And at the same time, it's probably increasing the risk of a slower path of the global economy. We're obviously quite far away from that turmoil, as is the US. So those two markets are still holding up better than the likes of Europe and the UK, which are right in the firing line. But the impacts of that will sort of reverberate sort of around the world. So as we sit here today, world shares are down about 12.5%. Since the beginning of the year, and that was sort of where the peak was, basically at the end of last year as well. So if I look back through, the last 75 years, there's been, I think, 32 corrections over that time frame. I think 9 of them, 8 or 9, turned into full-blown bear markets because they, were associated with recessions. Of the others that were just corrections, the average sort of top to bottom fall was about sort of 15 or 16%. So you could sort of say at the moment, this is just sort of your normal garden variety sell-off or correction, and they do happen pretty regularly. They come every couple of years. So on the one hand, sort of it's just business as usual. If you're a long-term investor, this is just par for the course. Markets don't just always go up. You get these periods of sell-offs, especially when things have got overheated and you're at a bit of a turning point for the economy and for the share market. But I guess what we don't know is a couple of things. One, we don't know where this conflict ends, and that's a real key factor. It could blow over the next 2, 3, 4 weeks, or it could escalate and get worse. So that's one issue that markets have got to get to grips with. And even if you do see it sort of de-escalate, you've still got that lingering inflation issue in the background, and markets will very quickly flip back to sort of worrying about high inflation and potentially rising interest rates. In that regard, that's a bit more of a slow burn issue, and I think it probably will be longer before we sort of know the answer to that. The positive scenario would be that over the course of the next 6 months, 12 months, some of the supply chain issues ease, some of the sort of heat in the sort of global economy sort of dissipates, and you get that inflation rate naturally sort of softening and falling into the back end of this year, which means that central banks then go, right, what we've done has had some impact. We've started to just take the heat out of the global economy. Those inflation pressures aren't as high, so we don't need to sort of go quite as aggressive with the interest rate hikes. But you know, if that's your positive scenario, and that's probably quite good for markets. What would be worrying for markets is, you fast forward 6 months or 12 months and the economy has come off the boil a little bit. Like, you think about New Zealand, the housing market's maybe come off. It's impacted our spending and our confidence. You've seen the labour market, maybe unemployment's, it's not as tight as it was before. So things have slowed down and the economy is maybe a little bit softer, and that heat's come out of it. But you've still got that very persistent inflation. And that's when some of these central banks have a really difficult decision to make, because they need to decide, well, are we going to box on and keep raising interest rates to deal to that inflation, or are we going to try and support the economy, support the employment market? And they could find themselves in a position where they can't do both of those things. And we don't know which of those things they'll prioritise. And if they choose to prioritise fighting inflation at all costs, they could find themselves in a position where they're still raising interest rates, still sort of making life harder for everybody and making the cost of money higher, while sort of the economy is starting to just wobble a little bit. And that's when you get sort of a reasonably unfriendly sort of combination for the economy and for financial markets. So at the moment, it does feel like, we're in a bit of a sort of a holding pattern where we don't know the answers to all of those questions. It's definitely the time to play it safe. I don't think it's time to sort of ring the bell and say, party's over. We're heading for a global recession, everyone sort of pack up and head for the hills. That's certainly sort of not what I would suggest. It always is sensible to be sort of, balanced and sort of hedge your bets. But it is a time for being a little bit more cautious, I think, if you're an investor. And that's the message we've been talking to our clients about, just be a bit more defensive. We've actually been suggesting people take a little bit of risk off the table and just play it a bit safer, because we are in a bit of an uncertain environment. So that's 10 minutes. Maybe I'll just stop there. I've touched on a few points. There's lots of things that I haven't talked about, whether it's tech stocks and why they've been weaker. I haven't talked about the currency, haven't talked, too much about, commodity prices or dairy prices, which is probably a good news story for New Zealand. But yeah, hit me with questions, and we'll use this last 10 minutes wisely before I hand over to much more interesting speakers than myself.
Well, thanks, Mark. Appreciate that. Definitely have some questions coming in. And I will just start talking about the tech. You just mentioned technology sector, and the question here says, in the last 10 or 20 years, we've seen tech companies boom. Which sectors and themes do you think will be worth investing in the next 10 years?
Well, I think I still am a tech bull. I think, when you think about the technology sector, it's on a 10-year view, it's absolutely where you want to be. The Apples and the Amazons and the Microsofts and all of those great businesses that we know and love, they'll only be bigger. They'll be much bigger. They'll be much more dominant. The innovation that's happening amongst some of those technology companies is just phenomenal. So I don't think anything's changed when you sort of think on a long-term basis. If I think about the places where, if I had to sort of lock money up for 10 years and I wasn't allowed to touch it, technology is right up there, with something like healthcare, which is also a very sort of good long-term structural growth story. So the long-term view is absolutely positive, but I think on a shorter-term view, call it 6 months, 12 months, the tech sector could still find itself under pressure. And the reason for that is really, remember that a lot of these technology companies, they don't have a lot of earnings or real profits. It's all some way out into the future. So when interest rates are really low, people are happy to give those companies the benefit of the doubt that, one day I'll get some profits out of you in 3 years or 5 years or 10 years or whenever. But when interest rates are high, the present value of those future cash flows comes down quite dramatically. So it's not so much the sell-off that you've seen in the tech stocks is not so much because their prospects have changed. It's almost a valuation rebasing. When interest rates are zero, people are willing to pay a really high price for some, unprofitable tech company that'll do really well in the future. But when interest rates go from 0 to 2 or 3, people aren't willing to pay that same price, and that that short-term sort of pressure on valuations rather than earnings could be something that prevails over the next little while. So I think you've got to make that distinction between the short-term prospects and the long-term prospects. If you're a share investor, you should be investing with a 5-year view minimum, ideally sort of 10 years plus. So anyone who's investing on a sort of 1 or 2 year time horizon, look, you're on the wrong asset class. Shut down this webinar and go and talk to the bank about term deposits or something. Everyone that's here today should be thinking with a 5-year, 10-year view, because you're in a volatile asset class. You'll get exceptional long-term growth, but it will come at the expense of those shorter term ups and downs. So I think tech's a really good example of that at the moment.
Any thoughts on any shifts in growth versus value stocks, or what you're allocating to those divisions there?
Yeah, I think it's the same story. So, just for other listeners, the growth stocks are those sort of high growth stocks, whether it's tech or some of the high PE, high multiple stocks. And the value stocks are sort of there, your boring meat and potatoes companies, whether it's the energy companies or, companies like McDonald's and just regular sort of traditional businesses that aren't trading on such high valuations. Growth stocks have been the place to be as interest rates have been cut and remain very low. Since you've seen that sort of shift in rhetoric, obviously people have flipped out of the growth stocks and into the value stocks. Some of those growth stocks are literally the best businesses in the world, and they're still the ones that I want to own. So I'm not inclined to sort of be selling my my Mainfreight or my Fisher & Paykel Healthcare or my CSL in Australia or my sort of Microsoft or my Apple, because those are sort of ones that I want to hold for the long term, and I'm happy to just sort of wear a bit of short-term negativity on those. But at the same time, yeah, I think people do need to make sure that they don't own just those types of companies. You need to make sure you own some of the value stocks and the stocks that are sort of traditionally better performers in a rising interest rate environment. And when interest rates are going up, things like financials do quite well. When inflation's high, it's traditionally things like commodities, real estate, infrastructure. So I think it's not about sort of being one or the other. It's making sure that you've sort of got your bases covered and you've hedged your bets. You obviously want to have some Sky TV and some Skellerup obviously in the portfolio too, because they've both got a bright future. But when you're uncertain, and none of us have a perfectly working crystal ball, so we've all got our view on how the inflationary backdrop will play out, how the Ukraine situation will play out, how the central banks will respond over the next 1 or 2 years, but we don't know that with certainty. So I think whenever you've got sort of facing that uncertainty, you sort of go a little bit closer to your benchmarks and just hedge your bets a little bit more.
Nice. And we talk about interest rates, inflation. How do you think increasing oil prices what will that mean for investors?
Good news if you're invested in energy companies. The energy sector's been sort of one of the only ones that's sort of going up this year. For the rest of us, it's bad news. Higher oil prices, that's a tax on everyone. It reduces your spending power, it takes money out of your pocket, it increases the cost structure for just about everybody. Fuel, either indirectly or directly, is a big part of sort of everyone's cost structure. So high oil prices are not a good thing. They're not helpful at all at the moment, because they slow economies down and they slow the consumer down. At the same time, they keep that upward pressure on inflation. And if oil prices stay at these current levels, just prepare for some pretty horrendously ugly inflation prints over the next sort of 6 months or so. But don't underestimate food either. You put Russia and the Ukraine together, and I think they're responsible for something like 25 or 30% of the global wheat trade. So that's one of the reasons why you're seeing the dairy price through the roof. All of these agricultural commodities are also exceptionally high. Now that's good if you own a dairy farm in the Waikato, but for those of us that don't, we're getting slammed on the energy prices, we're getting slammed on the food prices, and those things will sort of feed into that inflationary backdrop too. So again, the longer it continues, the more difficult a position it puts some of those central banks into, because they're then faced with more of an economic, slowdown potentially, but higher inflation over here, and it just gives them some really difficult choices.
Yeah. We do have several more questions. I'm going to kind of tie into what you mentioned about dairy prices, and this will be more of a New Zealand kind of centric question, but with the rising cost of fertilizer and commodity prices, what effects could that have for the New Zealand ag industry or the country as a whole?
Well, we're really lucky that we're just a big farm growing grass and selling milk powder, because that is, going phenomenally well for us. So the dairy price is up 20% this year, the global dairy price. It's back at levels we haven't seen since 2007. It's higher than it was when the previous record payout came in 2013-14. And not only that, but the Kiwi dollar is at sort of 68, 69 cents, whereas back in 2013-14, it was 85, and back in 2007, when prices were last this high, it was 75. So that's why you've got a payout that is the highest in history. Fonterra payout's going to be $9.60. It could even push a little bit high. It could crack $10, which is, great news for us as a country, because it means that, we've got all of these sectors that are doing it tough, whether it's travel, whether it's tourism, whether it's hospitality, whether it's retail. The agricultural sector is actually performing pretty well. So that's, that's great. Even though sort of, sadly, part of the reason for that strength is, what we're seeing over in Ukraine, which is obviously not something we want. But the New Zealand agriculture is in good shape, and it continues to perform well, which I think, puts us as a nation in, a better place than we would otherwise be. Same for Aussie. That's one of the reasons why the New Zealand economy, the Aussie economy, are holding up better than most, is because we're very commodity driven. Then with the hard commodities you dig out of the ground, us with the agricultural commodities. Skellerup know all about that, so I'm sure David will talk a little bit about the outlook in that regard.
Yeah, Mark, really appreciate it. We do have a couple more questions that we will send on to you after this. And thanks for putting the thoughts together and the time to join us and answer questions. So thank you very much.
Thank you. Thanks, everybody. Enjoy your next speakers.
So we will now move on, and I'll introduce Sophie Maloney. Sophie is the CEO of Sky Television, or excuse me, Sky Network Television. Sophie is an accomplished New Zealand media leader who brings deep international experience to the role, and we really appreciate you taking the time to chat with us and share some knowledge. And I will turn it over to you, and we'll come back soon with questions.
Doug, thank you, and thank you to NZX for hosting. Mark, I'm glad you made one reference to us in there, along with Skellerup. But look, kia ora tātou, my pleasure to be here and to share a bit of our story. Of course, a disclaimer, which is there, good to put that up. And so what I want to do in the time allocated is do a fairly whistle-stop tour through where we're at as a company. And then following Mark's example, look to leave as much time as possible for some good Q&A. So starting first with our strategy and what matters most. Well, we keep it simple at Sky, it's our customers. And what do? Well, we try our best to connect New Zealanders with the sport and entertainment they love in ways that work for them right across the country. And I think probably the biggest shift for Sky is trying to be better at delivering in ways that work for everybody. And I'll come on to that again in a moment, noting Mark's comments about inflationary pressures and the impact on the household wallet. So 4 key focus areas, as you'd anticipate: customers, content, our people, and then of course how that delivers in terms of our financials. Ultimately, we're wanting to be one of those companies that Mark would talk about in terms of a sustainably profitable entity into the future. We've had 31 years so far, and I'm hoping we can plot a path to another 31 to come. So turning then to the next slide, and just thinking about trying to give you a sense of us at a glance and talking a bit about our competitive advantage, looking at each of those areas. First up, it is about our loyal customer base. We deliver a huge amount of content into homes right across New Zealand. And, oh, yeah, you're there still, the slides are there, very good. And of those homes that are fibre connected, you can get the benefit of Sky Broadband as a Sky customer. These customers are our core strategic strength. Those who have been with us for more than, 75% of them has been with us for more than 5 years. And it is, you know, our satellite delivery to all of New Zealand in a very reliable way is what it's got us to this point. That said, it's not all about the box. We also have seen some significant growth in our streaming services. Neon for entertainment and Sky Sport Now as our standalone app. Both of them are experiencing phenomenal growth. But for those New Zealanders who do not subscribe to any of those products or services, or who are not able to, they can enjoy a selection of our content via Prime, which is our free-to-air channel. And of course, we have about 7,000 relationships with pubs, clubs, hotels and motels right across Aotearoa, New Zealand. I couldn't do anything that I do without having a great team, and I'm hugely grateful to their mahi over this time, particularly with the COVID constraints, and continuing to deliver to our customers, whom we know that Sky has been a real companion, particularly as we've been shut off from the rest of the world. Turning then to that competitive advantage, and first up to talk about our content. We are a content company at our core, and as you can see, we do partner with some of the biggest brands on the planet. What does that mean? It means that we can deliver a year-round diet of sport and, of course, entertainment, which I sometimes think we forget to celebrate. Thinking about news, particularly now, very topical, bring that in from across the world, as well as movies and entertainment and series for all of the family and everyone at home. Probably the happiest place I've been for a while, in the sense that we have a really good runway in terms of those core rights. So the NRL, the league, was the big one that we needed to secure last year, which we have out until the end of 2027. HBO, which was being shown into homes from August last year, particularly salient for Aucklanders in that longest of lockdowns. And more recently, securing the Premier League, which will be back on screens from August this year for 6 seasons, which we're hugely excited about. In each of these cases, as we've been sharing with our investors, we are very disciplined. Sorry, not just yet, I'm staying on the content, thank you. Very disciplined in our approach and making sure that we're looking at our data and insights to determine what content is going to make sense. And I did just want to do a couple of small shout outs. One is to, yes, we acquire a lot of content, but we do actually produce a lot on the ground. World-class sport coverage in partnership with NEP on the ground here. And we also partner with New Zealand On Air to deliver homegrown original content via Sky Originals, the latest of which is called Raised by Refugees, which is going out on Prime and is also on Neon. So what does this all mean then in terms of where we're at as a business from a financial perspective? I've been talking about last year being a time of building belief after what has been a pretty torrid time for our shareholders in Sky, and I'm confident that we're now in the positive inflection point. Why do I say that? Well, 6% year-on-year growth in our customer relationships. So it's our Skybox base, which is continuing to stabilize, as well as, of course, seeing growth on the streaming side. What does this mean in terms of our revenues? Well, again, pleasingly, we've returned to revenue growth. The first time been able to say that in 6 years. So hugely positive for us here at Team Sky. Where is that coming from? Perhaps unsurprisingly, it's from the core box service, but streaming revenue is also up 34%, as we noted in the first half results. On the commercial side, that's our pubs, clubs and licensed premises business. It's been a tough time, as everyone will appreciate. And so we have been supporting those customers with discounts. And we look forward to those borders being open and to the red light settings changing so we can get back more to normal. And advertising revenues as well are now returning to some levels, which is good. On the cost side, yeah, those rights that we talked about, they do come at a price, and we have, as we've been very clear about, stepped into some higher rights. But at the same time, we've started to really focus on all of the non-programming rights costs, which then enabled us in December, 7th of December last year, to communicate those FY22 savings of 40 to 45 million, which has enabled us to re-guide the market and upgrade the guidance, particularly around EBITDA and NPAT. Looking ahead, I think that we've grabbed hold of the, as they say, it's a little bit trite, it's the low-hanging fruit, and it's going to be harder work from here, but we've got our sights set on more of that cost review into FY23. So, very importantly, for us as a company and our shareholders, that sees us returning to sustainable free cash flow levels. And as a result of having clarity on those rights costs and confidence in where we're headed with our customer base and our strategy, the board has reinstated dividends, 50 to 80% of free cash flow. That range is about flexibility, not confidence. And as it stands, the board expects to approve the initial dividend in September 2022. So a hugely positive move. Questions will be asked though, because we are generating more free cash flow, strong cash balance at the end of the year of 74 million. We're also in the process of almost completing on the sale of our Mount Wellington premises, which sees a further net 55 million coming in. So, you know, a significantly positive place to be. And obviously there is interest in what we're looking to do. What we've communicated to our investors is, with my new executive leadership team who I've just formed and in conversation with the board, just pausing briefly to have a look at anything else we need to invest on internally, or if there are any other opportunities outside that could actually help supercharge the growth of Sky and continuing to deliver those, well, returning to deliver those returns to shareholders. So again, anything we're looking at is going to be incredibly disciplined, and we're very mindful of the patience of our shareholders, so that if there isn't something significant to invest in, then as the chair set out in his letter of late, we will be looking to make a further capital return to our shareholder base. So that's where we are in terms of the core financials. Just before I close out, being conscious of leaving time for Q&A, I wanted to very briefly talk about our new Skybox. We're hugely excited about this launch and delivery into customer homes from the middle of this year. It's been a long time since Sky brought a new piece of tech into the home. I don't know if many of you remember 2006, 2007 when we brought out My Sky Recording. You could pause live TV. It was pretty amazing. This box and the customer experience is that type of game-changing experience. So we're really excited about it. We know it's been a long time. It's a weekly update that I have because it's a very important project for us. But this new box is going to reconnect Sky with the choice and ease that I think we were known for when we launched. It's a voice-activated remote, the best of your free TV, your Sky TV, and in time, your favourite apps, starting with Netflix, all in one place, made easy for you. So, to finish, I'm really excited and I'm energised and feel very privileged about the position, you know, to be in the position that I am, leading out for Sky at this time. And look, I welcome any and all questions that you may have or other feedback for me, either as a shareholder, potential shareholder, or customer. Thank you.
All right, thank you, Sophie. Definitely have some questions coming in. Seem to be a lot around the current economic environment and competition, and how do you stay relevant as people's, I guess, disposable income is shrinking a bit. What what is the competitive landscape, and how do you or what is the plan, I guess, to attract and retain customers over the next 5 years? I guess the Skybox would be one of them, but other things like that.
Yeah, so look, and I meant to touch on it. It's a very fair point. So number one is to deliver the best content and experience into the home, and the new Skybox will do that. But we're also very mindful that there are household wallets where if you're talking about an average revenue per user of $80 a month, that's too high. So at the same time as bringing out the new box, we've been doing a lot of work on our pricing and packaging. And what we can see and acknowledge is that whilst there are a lot of Kiwis who love their sport, there's a decent tranche who are not so interested, but they do like entertainment, and we have the entertainment they like. It's just not priced and packaged in a way that's accessible to them. So we're looking forward to being able to communicate with customers later this calendar year around some new pricing and packaging that I think vitally importantly is going to be delivered in a way that you don't feel constrained and that you feel like you have more flexibility in terms of your disposable income. Equally, we are thinking about how do we make more content available in front of the paywall, and what does that look like in partnership, particularly with our sporting codes. We learned a lot this last year with the Olympics, both the summer and Beijing Winter Olympics, about free-to-air coverage and also access via social media, meeting customers where they are. And we look forward to sort of taking that forward and making more content available to more New Zealanders in different ways.
And in terms of competitors, do you view streaming services? It sounds like that was a big area of growth. Are those your kind of main competitors, the Netflix, Amazon Prime, or is that part of your packaging? How do you kind of?
Yeah, I think that I see them as, I think that with this new box and the ability to be that platform and have apps available via that ecosystem, and think about bundling them with our content in a more cost-effective and simple way for Kiwis, we think will be hugely positive. So in that sense, Netflix is a key relationship we will have in terms of that relationship on the box. For the standalone apps, Neon, people recognise that would see it as having a lot of HBO content, which it does, but it's also powered by other studios. So thinking about that role of the aggregator, even in the app world, is something that we're really mindful of. On the sporting side, I think that we're in a strong position. I think that the optionality with Sky Sport Now, and learning as we are about doing different passes, so a weekly pass or the tournament pass or the Olympics pass, enabled new customers to come and enjoy the app, explore it, and enjoy the content. And if they know it's there, they may well come back again. So again, it's just about testing and learning. But in that space in New Zealand, we think we're very well placed.
A question around sport has come in. It says your streaming service is growing. What are the plans around improving the customer experience? Things like full match replays for sport and on-demand viewing of other programs.
Yeah, it's a continuous improvement program. So we welcome that feedback. The team, this is part of when I talked about thinking about other investments we want to be looking at. How do we make sure that it is the very best experience for New Zealanders? And we do note and acknowledge, people learning from other apps what the best viewing experience is. So yeah, that's definitely part of our game plan. Nice.
And then the final question, and there are a few more, but I will send those through to you and get them out to everyone that has asked. I'm just reading, is the substitution effect to internet-based content a major risk to long-term earnings, and how do you mitigate that? And I'm guessing is that things like YouTube or other internet services?
Yeah, I think it's look, I understand, and I understand that everyone gets caught up in reading about streaming companies and what they're doing. I think what we're seeing globally, there's a bit of a cooling maybe in terms of the Netflix numbers, and I know Disney Plus is also looking at bringing out an ad-funded tier because they're getting to a saturation point. Vitally important for us is that we are, as I said right at the top, all about the customers and about the life stage segments. So we genuinely do want to make sure we're maximising our investment in our content and our experience to meet as many customers where they are. So if you love watching on the box and it's linear and you know exactly how it works with our current box, please keep enjoying it. The new box we're hoping will be of interest to a number of existing customers and new. And if you think about that, there is a power of the bundle, particularly in New Zealand, where we have a very strong competitive advantage. But we're not resting on our laurels as we continue to think about how do we evolve our streaming apps and how do we evolve content outside of that paid window, again, to try and build up and diversify our revenue streams, as well as continuing to manage our costs. So from my perspective, I think we're really well positioned to continue to deliver on that revenue growth story for many, many years to come.
Sophie, thanks a lot. Great presentation, and really appreciate you going to the answers. Really good info, and thanks for the time. We'll get you more questions.
Thanks, Doug. Much appreciated.
Yeah, thank you.
Thank you.
Now we will turn it over to our last presenter, and we have the CEO of Skellerup, David Mair. David is the CEO, as I said. Skellerup is a company that designs, manufactures, and distributes engineered products, footwear, rubberware, and more. And David recently took out the CEO of the Year award at the Deloitte Top 200 Awards, which is a great achievement. And we appreciate him being here and sharing some time. So, David, I will turn it over to you.
Thanks, Doug. And I was just reflecting on Sophie's wonderful presentation. So I have 3 slides. I'll go through a quick update on how I look at Skellerup and why I think it's a great business. So if we start there first, over the last 5-6 years, we've worked very hard on executing a strategy that we've talked about. It's an OEM strategy. So OEM is original equipment manufacturer, and we, in general, create from scratch, often an essential component of a customer's system. So one of the advantages that Skellerup's had, in a funny way, with all the things happening in the world, is we are a diversified business, and we have growth opportunities in all the international markets. The OEM business model is great because one of the things, I was just reflecting on Sophie's comment around customers, we want loyal customers. So we're not so focused on customer satisfaction. Of course, that's important, but customer loyalty is far more important to us. So when we do a really good job solving a problem for a large OEM customer, for example, Moen in the US, Moen make a large range of tapware for houses. So most of the houses in the US, new houses, they have a tap, and inside that tap there's a critical component, which is the cartridge. And we supply almost all, if not all, those cartridges. So of course we're exposed to the housing market and things like that. But one thing for sure, if you don't let them down, you don't have to worry about them not ordering next month or changing their mind and switching and things like that. So it's a really interesting thing. And the secret sauce of Skellerup, if I could help you understand what makes this a really interesting business, we take deep material knowledge, and some of those materials are not easy. They're sort of counterintuitive to people that are used to using metals, for example. So I'm really talking about rubber and silicone materials. And we have a fantastic design process that takes into account scalable manufacturing and also essential tooling that can deliver high reliability in those products. And then we have manufacturing process expertise where we can combine those materials in a way that often takes complexity away from customers. So we have a great sales guy in the US. Of course, in the US, he's an Australian and he likes McDonald's, and he often says, "Would you like fries with that?" So one of the things we've done really well is to go into a customer and we end up supplying maybe an opportunity to supply some rubber bits, and then we add some plastic bits, and in the end we supply the whole critical component of their system. And this is not something that we can do quickly or easily or things like that. It's not that we wait for those opportunities to come along, but I think globally our team have become far better at that approach. And hopefully you can see it in the numbers. So I have to say, like Sophie and others, I'm just in awe of how well the team have done over the last 2 years. And one of the advantages, again, we had is we saw it happening in China. We saw the COVID thing happening in China. We saw it roll into Italy. We had a lot of time to prepare. So just a few highlights. Obviously, we had a very good year last year, so earnings were up. The dividend has been up over a 5-year period, not just in 1 year. We had a record result last year. We did our half-year result recently, and we had a record result there. Our guidance says that we'll have a record result. It's interesting about the timing. Our fiscal year is 30th of June, so it'll be interesting to see how the numbers fall out. But to be honest, we're taking a 2 to 5 year view. So Graham Leeming, the CFO, and I work very hard, certainly in the next 2 years. And I'm not as concerned about what might happen in May or June individually. I'll come back maybe to some of the back winds. We see a number of favourable things happening. It was mentioned earlier by Mark that, for example, dairy prices are as high as we've seen in New Zealand. Oil prices are very high. That's not necessarily a bad thing for Skellerup. And there are some other back winds, but we'll come back to that later. Just one important thing is we have a very strong operating cash flow and a strong balance sheet. So one of the reasons is that not just the result and everything, but our customers don't give us contracts, but what they do is they pay for development. So in other words, a large chunk of the development risk cost is taken by our OEM customers. And that's as good as a purchase order, not quite. I prefer the purchase order because then you can record the sales, but once you made it and sell it. But what it does mean is you have very reliable business. So over time, I think that the key to Skellerup and why it's become a much better business is we've taken businesses that has been exposed to big swings. So for example, iron ore and funny enough, oil and gas. I remember when I took over as CEO in 2011, the iron ore price was $120 US a ton and oil was $120 US a barrel. And the view has been since then, we're unlikely to see that. So that's been interesting in the last 6 months reflecting on that. But anyway, without getting into too much detail, as I said, I'll keep going. So what Skellerup is, one of the keys is to have these long relationships based on solving real OEM customer problems. And I was asked relatively recently over the last, say, 10 years, how many OEM customers have you lost? And I was thinking I can probably count 2 or 3. And certainly one of those was one we wanted to lose. We put the price up. We had an issue with their view of what good business was, and they've decided to source from somewhere else, which is great. I've explained the materials, product design and process expertise, but I think the other thing that we think about a lot is, certainly with our strong balance sheet, we think about shareholder returns. And certainly from my point of view, I'm a reasonable shareholder in Skellerup. It's been very good. We often have discussions around how we can return money to shareholders, not just dividends. We've looked at capital repayments. We've looked at a number of things. We even considered and discussed share buybacks, those kind of things. But the critical thing at the moment is, of course, we're in a good position to grow the business. And we have been looking for acquisitions. Again, I get asked a lot, has the inability to travel reduced the opportunity for acquisitions? And of course, the answer is yes. It's very hard for us to do acquisitions without actually seeing the business, and we would like those to be aligned. There's less risk of joining the 9 out of 10 acquirers that pay too much for businesses if you can actually see how that would fit with the existing business that you have. Having said that, we've done a couple of small ones, but it would help if we could do a bigger one. But I suspect those opportunities will come up in the US, so hopefully that will happen soon. So then just a reminder a little bit, this is in our annual report, so if you're interested, you can see a full blow by blow, but just before we get into the questions, one of the things I'm always impressed with Skellerup. I mean, I've been involved since 2006 as a director and then parachuted in as CEO or managing director. There are just a whole lot of things that when you drive around, you just don't think about that we are involved in. And there's not a week that goes by that I don't learn something else that we do that I didn't know about. And it kind of sounds funny, but I think there will be a re-rating of companies that can manufacture essential goods in market. And so one of the key focuses I have at the moment is how can we cost effectively manufacture in market? So a lot of our sales, so 80% of our revenue is overseas, 70% of that revenue is manufactured overseas. And so there's a big focus on New Zealand. So just last couple of thoughts about New Zealand. Most people think of Skellerup as making red band gumboots, fantastic brand, but it's such a small part of our business relative to some of the other things we do. And so we're in really interesting things. As you can see, orthotics and prosthetics. We do a lot of hygiene products. And from my point of view, I've never seen a pipeline as full of new opportunities. So we're in that wonderful position of picking and choosing what we focus on, and it's a balance of organic growth and some adjacent business opportunities that mean that, from my point of view, I think Skellerup's just going to grow stronger and stronger, and that's exciting. So look, without further ado, there's the usual disclaimer, like Sophie said, and then I really welcome any questions. So thank you very much for your time, and thanks to NZX.
Thanks, David. Very good information. I think we do have a couple questions coming in, and you talked about building loyalty and long-time customer relationships, and that is a great part of the story. On the flip side, how difficult is it to acquire new customers, especially from the OEM side of things, and what type of acquisition costs and time is involved in that, and how do you go about that?
Yeah, it's a good question. So certainly when we were operating in the US market, and the person I referred to who likes McDonald's, he was living in Australia. It's incredibly hard to get the relationships needed in market if you're not in market. So he moved to North Carolina, and he operates the business there, and that's been growing. The other thing is once you're in a vertical, once you're in, for example, potable water applications, I mentioned Moen, then it's much easier to get Kohler, the shower company, even though they're not quite competitors. It's relatively easy. So the interesting thing, and I've been reflecting on this, some of those new opportunities have actually come from the good work we've done with Moen, for example. I'm just picking on one OEM, and where an engineer has been headhunted out into another private business, and suddenly, Bob's your uncle, they need a new product, it's taking too long, their existing suppliers can't do it. And in frustration, they reach out. And the fascinating thing there, the thing that takes the longest is to get loaded into their computer system. So we actually created testable, that's the wrong word, products that were fit for test, so proof of concept components. We did in 2.5 weeks, got it to the customer before Christmas. They couldn't believe they'd spent 6 months trying to solve this issue, and we solved it in 2.5 weeks. Once you do that, the loyalty, not only now, but into the future is great. And one other thing, there is a lot of organic growth if you get this right. Like Moen's game plan at the moment is to acquire other tapware companies, and they've created a platform using this cartridge. So they acquire a company and then they roll out their platform, and guess who gets the cartridge? Because we are, in this case, a sole supplier. Of course, they'll try to change that, but that's fine. But acquiring business, OEM business, is really difficult because unfortunately in New Zealand, we have a lot of businesses that focus on sort of a commodity approach. And so it's very hard to train people in that way. But we're fortunate, we have an international business. So there are a lot of Germans and English people, and certainly in America, it's easier to find salespeople who can do the deal. They can build the loyalty and they can do the deal. They have to be technically competent and commercially astute. It's not an easy combination to find.
Yeah, very good answer. You talked about being in a position to grow the business quite a bit in acquisitions. What are you seeing out there in terms of acquisitions, in terms of areas that are of particular interest? And are there companies and businesses within New Zealand that might be targets? Do you see a good fertile ground locally, or is it more abroad in the US and elsewhere?
Our target market for the last 5 years has been the US, and it has slowed down in terms of my ability to get there and look at things. I'm sure there's some bigger opportunities, and of course, in general, you might be able to add a 0 to the number in terms of the scale and the opportunity in the US compared to New Zealand or Australia. But last year we acquired Talbot. It was a plastics component business in Christchurch, and the year before that we acquired a silicone tubing company in England just over 2 years ago, just before COVID. And we did those very quickly and effectively. So one of the advantages of a small company is if you establish a bit of a relationship, you can get are you willing to sell, okay, 4 to 6 times earnings or whatever the sort of the mold. You can kind of cut through that and get exclusivity and get a deal done in a very short period of time. I think we near enough from starting woe to go. The real deal was probably about a month, so that's relatively quick. We've been looking hard in Australia, so we have 2 very good businesses, one in Sydney, one in Melbourne, and we've probably turned down 2 or 3 opportunities where the valuation difference was not suitable to us, but people are still talking because, of course, the world world is changing now, so their view on the future may have changed, but it's helpful to have relative clarity around how the businesses would fit into what we do. And so we have a very good team. So one of the advantages, again, of having a diversified business is I don't have to go there. I have people looking anyway. But of course, when it comes to the nub of it, Graham and I would like to be there. Acquisitions are fun, but you mustn't get distracted by them too much. But anyway, look, I must say that so just one other thought is that people say to me, particularly the New Zealand shareholders, our shareholders, they often say to me, "Gosh, Skellerup's boring. You just boringly do the same thing, but do it better, and we make more money." I don't see that as a bad thing, and I don't really see us as boring in that sense. But here's the interesting thing: there's a lot of talk about peak cow. There's, you heard Mark talk about the importance of agriculture. Well, if you read the newspaper, you wouldn't believe that with all the onus that is going on farmers and that. We desperately need, from a New Zealand point of view, to do well here. And we, not only is the dairy farm in the Waikato that Mark referred to, and I don't own a farm, but I'll tell you, that's really good for Skellerup as well. But what we need to do is we need to align those kind of efforts. So one of our adjacent businesses we've been looking at hard is non-bovine milking. But just the last thought on that, I'm conscious of the time. The total demand for protein, which is really what milk powder is about, it's about protein for Asia, if you really distill it down. And if you add together all the soybean, false meat companies, and if you add it all together, there's not enough to meet the demand over the next 10 years. So what we have to do is pick and choose carefully how we go about this and try to build loyal customers, because then they have no reason to change. So we work very hard on that loyalty, and interestingly, we think about bundling and some of the concepts that Sophie used. But for us, the critical thing is to solve technically solve a customer's problem in a way where they believe in us, if that makes sense. So look, last of all, I'm just really proud of how not only our company's done. I mean, I was part of the awards recently for Deloitte, and I was just stunned at how well some of these companies have done. And of course, one of our directors is from Fisher and Paykel Healthcare, fantastic business, Mainfreight. I'm a shareholder in Mainfreight. They've done extremely well. So, I'm really proud of what New Zealand's achieved through pretty tough times. Anyway, thank you, Dave.
Yeah, no, plenty of time there. We'll do one more question and then get you a couple more. We do have a few minutes left. This is kind of a bit of a shift, but it's around the topic of ESG and specifically carbon reduction. Do you have any plans around that for the business, and any way to drive a competitive advantage around those areas?
Yeah, it's an interesting topic. So first of all, I split it up into recently I was quoted, one of the things we've done on the yes side is to try and ensure that, we are ensuring that the lower paid people have been lifted well off the minimum wage. And I don't mean New Zealand, I mean China, I mean the UK, I mean Australia and things like that. So obviously we have a relatively big bottom bell-shaped sort of curve in terms of income and things like that. So, we've had a plan for a long time that I don't know how a New Zealand family could live on $50,000 gross pre-tax. And so we've made a real effort to lift how we pay people at the bottom end. Of course, that has to be paid ultimately by productivity or customers in some way or something like that. But we've focused very hard on that, and that remains a key focus for us. And despite the hybrid work and all those kind of things, we have a lot of people that make real things. So we need them to be in a factory environment or something like that. So the loyalty of our staff is as critically important as the loyalty of our customers. And so I think we've done really well there. On the environment, most people pick ESG as environment and carbon and all those kind of things. So we've taken steps in the past to move ahead. For example, in China, we had a coal-fired boiler, and I think it's 8 years ago now, we replaced that with natural gas when it was hard to get natural gas. But just one thought, because of the earthquakes I took over in 2011, we had to effectively move our site in Christchurch, and we created a new site. And what we did is we create water. Fresh water is very important to us. And we recycle somewhere between 93 and 95% of the fresh water. The next stage is we intend to completely close the loop. In other words, we don't need to add any water in and we don't create waste. Now, once you've done that, there's nowhere to go, if that makes sense. But another part of our focus, of course, is, I mean, the obvious stuff. We've eliminated a lot of packaging, plastic packaging in particular, but even down to the materials that are used in our products. So, of course, if we can save on waste, that's a gain, but more importantly, a lot of our products are shipped around the world. So just specifically on shipping and how we're dealing with that, and I mentioned earlier, my focus is to be able to manufacture and market at Asian costs. If we can solve that, then we have a very, very strong business. But I think shipping is going to remain an issue for quite a long period of time. And of course, that has a huge impact on carbon. Bunker fuel is the worst fuel.
Well, David, great answers, and appreciate the time and excellent presentation. I think it was super informative, and that will do the presentation for today. I want to just thank again Mark, David, and Sophie for taking the time to put some thoughts together and sharing time with us. All the attendees out there, any questions that you think of that you didn't get a chance to ask, just let us know. And there will be a replay of this webinar as well, and we'll send the link out there. It's a YouTube link, and please get in touch after that if you need to as well. So thanks again, everyone, and really appreciate the time.
Thank you.